Hey everyone, welcome to another episode of Brett's Brain. Today we're going to talk about down rounds, the effect they would have on your startup, what they are, and how investors think about them. Hey, I'm Brett Burrell, former entrepreneur, current venture capitalist. Thanks so much for checking out the channel where we're trying to help entrepreneurs succeed. Make sure you share, like, subscribe, and ask us questions so we can help you in your journey. All right, a down round. Today, as we sit, there's more and more down rounds happening and affecting both the entrepreneurs and the investors that have already put money into those companies. It's not as liquid of a market. Valuations aren't as high. So what actually is a down round? A down round is when you go out and you raise a new round of capital you've already raised in the past, and you raise it at a price that is cheaper than it was whenever you raised last time. So a lot of rounds that are going off right now in 2024, the last time that founder raised was in 2021 or 2022 when the market was still pretty frothy. And so you might have gone out and you might have raised at $1 a share. And today when you go out to market and you get a term sheet, the term sheet's for 75 cents a share. And so you're actually going to be selling shares of your company for less than you shared 2 years ago, even though you've made progress and you've made change, you've worked hard for 2 years. And so it really kind of doesn't feel good. But here's a couple other things to think about of how it affects your company. Well, one is it can actually make it much harder to raise the round itself. So people like to invest in things that are going up and to the right. And regardless of whether it's right or wrong, if the indication of or what it indicates when you're raising a round that is at a lower valuation is that something didn't go right. You didn't perform as well as you thought you were going to perform when you raised your last round. So there's something there. So it immediately creates a red flag. If you don't have insider support on this down round, it tends to be really difficult to go out and raise it. Because again, that's another indicator of how's the company doing. So not only is it a down round, but none of the insiders that already invested in you once are trying to invest in the new one. And so these are some watchouts for founders as you go to raise. And it's one reason you hear a lot of people talk about, should you try and maximize valuation? And the answer is like, maybe, maybe not. Maybe there's other things that you should optimize for so you can prevent the potential of having a down round in the future. Because it is an indicator of startup health and it can make it harder to raise that next round of capital. Another reason it can be hard to raise that next round of capital, if you're going to think you're going to be raising at a lower valuation, is that not all investors love coming in and giving a term sheet for a down round for the reasons I already stated, but also because it can create a tough situation. You come in as a new investor and you give a term sheet to a startup where both the entrepreneurs and current investors that have supported it from early on invested at a higher valuation last time. It kind of makes you look like somebody that's not that nice, that's trying to take advantage of the company. When in reality, that's where the market might be. Or that's where like you see like, hey, we'll come in and invest, but only if it's at this valuation. And from a brand perspective as an investor, from a relationship perspective as an investor, sometimes it can be really difficult to get over that line and say, yep, we want it. We have enough conviction in making this investment decision where we want to issue a term sheet, even though it might make some people upset on the current cap table, or even though the founder might not exactly agree with where we think the valuation should be. And so sometimes funds just avoid it completely. And that is the mentality of an investor. Like investors that put a term sheet out there at a valuation that is lower than a prior round valuation aren't always doing it to be a snake or to take advantage of a startup. That's not the goal. It's just, hey, here's where the market is today. This is where we should invest. This is where we're comfortable investing based on our fiduciary responsibility to our investors, where we need to provide returns. And so we're not doing it to take advantage of a startup. It's just, this is where we see the market today. And, like I've mentioned, over the last couple of years, the market has changed pretty dramatically for seed stage and Series A companies where valuations have come way down. And so you're seeing more of this happen. And you have to navigate it as a new investor coming into a cap table. You have to navigate the politics of existing investors. And it's really time consuming. You have lots of conversations. You do a lot of explaining around why you think this is the right valuation for the company. And so again, some investors just avoid it completely. And so that can really hurt you as a founder when you go to try and raise at a down round or a lower valuation than what you did in the past. Finally, the last thing to think about with down rounds is the dilutionary effect. So you've already raised one round of capital. So as a founder, you've taken dilution on that round. Now you're going to go raise another round of capital at a valuation that was lower than the prior one. So you're going to take even more dilution, even though your company might be further along. And so you might have taken 20% dilution last time for $1 million. And now you're going to take 35% dilution for $1 million. And all your investors are going to take that additional dilution as well. And so it really can become difficult, and your ownership stake that you still maintain as a founder can start feeling a bit small. The good news for the founders, if you're still active in the business, oftentimes you'll get what's called a recap or recapitalization at some further point down the line, or maybe even in this round, where the lead investor comes in and says, hey, we want to invest. It's going to be a down round, but the entrepreneurs are going to have such small ownership that doesn't make us feel good, because we want those entrepreneurs to maintain a lot of ownership so they still feel motivated to build this company. And so we might say, well, we want a 30% equity pool. And we're going to issue 20% of that right away to the existing senior leadership team on new vesting schedules to make sure that they still maintain enough ownership. That's the give, but the take there is that all of your existing investors that have supported you from the beginning are going to be the ones that eat that extra dilution for that equity grant to the founders. And so it's a give and take. And again, all of these things are why down rounds can be tough to get done. If you have a great company, you can still raise and you can come out of this. Like if you have to raise at a down round, you can still build a great company. You still have the potential to build a great company. So it doesn't mean you're going to die. It doesn't mean that your company's going to go away. But these are just a couple of the big challenges you're going to face in this market if you're trying to raise at a valuation that is a little bit lower than the one you raised last time. Thanks for listening. Make sure you share, like, subscribe, and ask us questions so we can answer them in the future.